Sanjeev Prasad joins us. Sanjeev, good morning. Thank you for joining us. Well, it's easy to talk about the small cap and mid cap sell-off which happened 15 days ago, but the reality is that we've done not well, but rather well for ourselves this year on all counts.
Yes, that's correct. I mean, if you look at the Nifty 50 index, that is up 20% on a calendar year-to-date basis. And in fact, the small cap, mid cap indices have actually done better despite the correction that you have seen recently. Obviously, all the going has been pretty good so far in the sense, you've had a lot of positive news in the sense, or rather, actual expectations of positive news in the sense of strong economic recovery, COVID 2.0 receding, vaccination rates picking up. Probably a large section of population already has got, affected in some form or other and has already got immunity. And expectations of pretty strong earnings growth. I mean, we also are looking at about 30% for the Nifty 50 index net profits in FY22, followed by another 14-15% in FY23. So a lot of good news so far. Most of it is priced in though. So I don't know how much more incremental good news is out there. And so far, the bad news in the form of potential increase in inflation and bond yield, interest rates, etc., have been, somewhat muted. And global central banks, or whether it is RBI, both are taking the call that inflation is well within control, even though the short-term numbers are on the higher side. They are transitory; it will come down, so there is no need to really pursue an aggressive tapering program, and it will be on lines of whatever the central banks have been guiding. So yeah, so as of now, a lot of good news. Priced in, I would say, incremental bad news probably not bad enough to drive down the market.
So Sanjeev, for markets to keep on going higher or stay here, it needs fuel. It needs that adrenaline. What is that trigger now? Because earnings are strong, liquidity is okay. What could be the next thing?
Well, the market ultimately requires earning numbers, and that's the biggest fuel for any market, right? The PE rating can take you so far. And if you look at the Indian market, you've already seen a fair amount of rating. So I don't know how much more rating can happen from where we are. So on Nifty 50 index, once again, if you look at the 12-month forward PE, we're already at about 22 times, which is on the higher side. If you look at historical trading band, which may not be the correct way also to look at, because the competition index also changed dramatically in favor of consumer stocks, insurance names, etc., where deservedly they should have much higher PE. But be it, at least on historical basis, the market does look on the higher side. And clearly, since bond yields are supportive on the lower side, that's what is supporting the market. If you look at individual stocks, everything has got rated pretty sharply compared to pre-COVID levels. If you look at IT stocks as an example, they used to trade at about 13 to 21 times on a 2-year forward basis. I'm talking about pre-COVID numbers. Currently, if you look at on a, again, 2-year forward basis, most of them are trading at about 18 to 30 times. So clearly there has been a big rating, and that is true across sectors. So I would roll out PE rating from where we are, especially given the headwinds of reduction in bond purchase programs by central banks going forward, including RBI by the end of the year, and maybe some interest rates increases in the second half of next year, both by the US Fed, also by the RBI. So the question is, whether earnings numbers can surprise on the upside. Doesn't look like as of now. We're already building a 31% net profit growth of Nifty 50, as I was talking about earlier. So I guess this market, could probably just be range bound. And as you roll forward to the next year and the next year, as we start discounting forward earning numbers, the market probably, goes up. So it is all about increase in earning numbers, right? So as of now, short-term increase in earning numbers I would rule out. But as you roll forward to the, in the future, to higher earning numbers, that would probably drive the market. So ultimately, it's earning numbers which are the biggest tool for any market, or any stock for that matter.
Somewhere, are you surprised or disappointed that banks have not participated the way one would have anticipated? Because the first proxy to economy is banks, And if I keep ICICI Bank outside, other banks have just done okay.
That is correct. On a one-year basis, they have done quite well. If you include, the NBFCs, Bajaj Finance, Bajaj Finance have also done very well. And on a one-year basis, actually, banks have not done that bad. It's only over the last 6 months, they have underperformed the broader market, but it's okay. I guess at this point in time, there are 2, 3 things which are probably acting as a drag on some of the banks. One is, how the whole banking space will evolve over the next 3 to 5 years. See, the historical narrative about the banking space in India was very clear. You just bet on private banks who would take market share at the expense of public banks, and one of the best, ways to play the entire consumption space. If in India, most people look to, invest in consumption names. And one way to do that was also look at financing consumption, which is what banks used to provide. So the narrative was very clear. You come to India, you look at consumption names, banks provide a great proxy to consumption, and any of the private banks would take it, market share expense of public banks. So it was no-brainer trade. Obviously, that has got muddy to some extent because now you don't know, how this whole banking space is going to evolve. You are seeing more and more competition coming from the likes of, fintech players with very disruptive models. They've already captured a fair share, of market share in the transaction/payment space. Whether that extends to lending, we'll have to wait and see. But clearly there are some concerns building over there that through the payments piece, many of these entities could actually build pretty good lending businesses also, starting from BNPL, which is the big thing these days. So that is one thing which is probably holding back some of the banks. Second could be more company-specific factors, for certain banks. You have seen HDFC Bank, which has gone through, some amount of issue with respect to its technology issues. Kotak has had, regulatory-led announcement from the RBI. So some of these, could be affecting the larger banks also, I would say.
Okay, hi Sanjeev, this is Mubina as well joining in. Right now everyone's talking about sectoral rotation, that the momentum trend that we've been seeing, wherein we've seen IT doing well, continues to do well, metals have done well and continues to do well. Do you see now a case that perhaps it's time to go overweight on those segments that have seen a bit of underperformance? Banks, you said in the last 6 months there's been a bit of underperformance. So do you see that sectoral rotation taking place at this point?
Well, it all it depends on future data points. Clearly a lot of good news with respect to IT and metals already priced in, right? I don't know how much more positive news is out there, especially for IT. In the sense, as I was talking about earlier, multiples have expanded significantly. Yes, current demand conditions are good, but there are supply side challenges also. So I don't know whether the earning numbers can surprise positively compared to the pretty high expectation which is already rising currently. Same thing holds for metals also. Everybody knows about a strong metal cycle. Analyst forecasts are now building in pretty high assumptions going forward with respect to prices and profitability for a longer period of time with respect to metal cycle. So I don't know what can surprise an upside. Now coming to some of the sectors which have underperformed, which we're discussing, banks will have to wait and see. But clearly the concerns around a more competitive banking environment not going to change in a big hurry, right? Over the next 6-9 months, it's not as if suddenly the fintech companies will disappear. That's not going to be the case. But the important thing would be whether banks themselves can demonstrate their ability or change the narrative in their favor, in the sense that they are also equipped very well on the technology side. They have access to big data. They can use all that to do a lot more incremental lending. So that is what could probably shift the narrative in favor of the incumbent banks. We'll have to wait and see how much disclosures first of all the banks come and give, and how much of the demonstration actually happens in terms of credit growth going forward. Do keep in mind the fact that last 1.5 years is anyway no test for any bank, because the lending environment has been very subdued. Overall credit growth is about 6.5%. So that doesn't say much about any bank's ability to lend or not lend in that kind of environment. But going forward, as the economy picks up, credit growth picks up. And if the incumbent banks, again, come back and start demonstrating pretty good credit growth, we could probably see some re-rating happening for the banks which have been laggards over the last 6 months or so.
Valuations have been, a bit of a concern. You've also, said that valuations in India are looking a little full. Is it IT where you believe that, on a historic basis, the kind of premiums it's commanding is a little too expensive? Or do you think that, considering the fact that the kind of guidance given by all of these companies, it's a fair valuation?
See, if you look at an historical basis, everything is well above, the median, trading range, or even the historical trading, and everything is on the higher side. So as I was saying about the market, if you look at the last 20-year P for the Nifty 50 index, it's more like 15, 16. Currently, it's about 22 on a 12-month forward basis. So clearly, well above even one standard deviation currently. But as I was saying earlier, also do keep in mind the fact that the composition index itself has changed dramatically over the last 3-4 years. Earlier, the Nifty was very dominated by metal mining names, oil and gas companies, power companies, and so on and so forth. Many of them have actually moved out of the index and replaced by very high PE consumer stocks, for example, or life insurance companies. So that is one point to keep in mind. The second more important point is, high valuation also supported by low interest rates / bond yields. If you look at historical gap between earnings yields and bond yield, which I track pretty closely, the time to get really worried about the market would be when the gap is something like minus 4%. When I say minus 4%, that's earning yield less bond yield. Currently, we are at about 160, 170 basis points. Really not that big a worry, I would say. Having said that, obviously, interest rates will start moving up. How much of that increase in bond yields can be compensated by, higher earning numbers? We'll have to wait and see. But as of now, we are looking at really high, incremental growth in earnings. So I won't be that perturbed by very high P numbers that you see. No point looking at, P numbers in isolation. You also have to look at in the context of what's happening to bond yields or cost of equity. And clearly, whether it is a market or individual stocks, everything is getting supported by fairly low interest rates and expectations of low to modest increase in interest rate. Nobody is assuming interest rates will go up suddenly. If that were to happen, which is obviously a low probability event, but clearly that would have fairly high repercussion for the market. You would see a fairly severe correction, but that's clearly not our base case. We are looking at very moderate increase in bond yields, both in India as also globally.
Okay. What's your take, Sanjeev, on autos? I think that's the one area where we've seen continued underperformance, and also valuations as well have still been on the lower side. They have the whole problem with respect to costs. Demand seems to be okay still, because we read about how some of the most prominent models of different brands have very long waiting periods. Some of them may be unlisted, but that's the case even for some of the listed brands. Do you think cost is the key pain point right now that autos will have to deal with?
I think it's a combination of both possibly subdued volume growth as also margin pressures. So on the volume side, I'm not entirely convinced you will see a very strong recovery this time around compared to the July to February timeframe last year when you saw a very strong recovery after COVID 1.0. And my concerns are as follows. One is the fact that rural India was also impacted quite severely during COVID 2.0. Whereas COVID 1.0, rural India was absolutely fine, and you saw very strong demand from rural India supporting two-wheeler and tractor volumes last year. Number two is urban India has had 2 years of significant impact. So at least lower income households have got pretty significantly impacted. Not that many of them would be consumers of auto, but at least whatever is migration you were seeing for some of these households from low income to middle income household, that would get disrupted to some extent. And more importantly, I would assume that a lot of households in middle income, high income, which are the typical buyers of two-wheelers, four-wheelers in India, I think they probably advanced a lot of purchases last year itself. So whoever had to buy a two-wheeler, four-wheeler probably waited and bought one, given concerns around using public transportation, even if it was available in the first place. So at least that's my thesis. We'll see how it plays out. So I'm not very clear whether you will see a big recovery in volume numbers this time around. Number two is gross margin pressure, which I talked about. Anyway, metal prices up significantly, plastic prices up, so obviously there's a lot of pressure. And the demand environment is not strong enough for the auto companies to pass it very quickly. So they have been taking gradual increases, trying to mitigate big increases which have taken place on the raw material side. But obviously that's not very easy to do that, in one shot. And the third and subsequent points would be more linked to individual sub-segments of the auto sector. For example, if you look at two-wheelers, first of all, penetration levels are already very high. Almost 60% of households in India already have two-wheelers. So I don't know what's the runway of growth over here. Second, you are seeing a big disruption coming in the form of electric vehicles, which are already fairly competitive. If you look at the full cost of ownership, actually EVs, two-wheelers are much more competitive compared to ICE two-wheelers. And you are seeing, fairly aggressive announcements from at least one player, and you have a plethora of smaller electric two-wheeler companies. So how the market should distributes, what does it mean for pricing and profitability of the incumbent players? We'll have to wait and see. Do keep in mind the fact that the incumbents actually enjoy very high returns and profitability. Even the smallest player, TVS, has something like 20 to 23% COCI, which is quite high. And unfortunately, that leaves room for a lot of disruption from the EV space, I think, over here. If we come to four-wheelers, Maruti has been facing a fair amount of challenges in the compact SUV segment, which is a segment which is growing. And obviously, this is more of a long-term problem, not really a short-term issue. We still don't know what is Maruti's longer-term EV strategy. Not that I need to worry about it now, because four-wheelers will take some time, for four-wheeler EVs to really become competitive with ICE four-wheelers. So you have a lot of generic factors. You have, company-specific factors also, which is probably holding back auto sector as a whole currently back.
Sure. Sanjeev, wanted to get your opinion on what are you making of the telecom story in India, as it's clearly headed towards a two-player or two-strong player market now, at a time when Bharti is announced a fundraise of a sizable 21,000 crore rupees. There are also news reports that Google may be looking in for an investment into Bharti. And also what my colleague is picking up, that Reliance Jio perhaps is going to be launching its low-cost smartphone in association with Google, something that they already highlighted on the sidelines of their AGM, that they're aiming for a 2G Mukt Bharat. We understand that about 5 crore handsets is what they're going to be looking at launching with.
Yeah, you're right. It looks like that's where the telecom market is headed. Given the financials of Vodafone Idea, and no signs of any increase in, ARPUs as of now. I don't know how long, Vodafone Idea can really sustain its operation, especially given a big increase in its, payouts to the government going forward. Both AGR and spectrum liabilities will start coming in soon. So clearly, it's not a very sustainable situation as far as VI is concerned as of now. I assume Bharti is raising money, because probably sees an opportunity over here. If for whatever reason, Vodafone Idea is not able to sustain, then you will see a lot of migration of subscribers of VI to Reliance and Bharti, and to 40 to 50 million subscribers of Vodafone Idea cannot be absorbed that easily. We need a lot more capex, to support that kind of a network. So I assume that is what Bharti is preparing for. And also maybe it is just keeping some cash in hand, given the fact that 5G spectrum auction could also be around the corner. So clearly it makes sense from a Bharti perspective, the fundraise that it is looking at.
Okay. Sanjeev, great to have you on the show today. Thanks as always for taking the time out and joining in.